There are three very common mistakes to avoid when you retire. The first is not taking advantage of tax loss harvesting. The second, similarly, is not taking advantage of tax gain harvesting. And the third is taking money out in the wrong order when you do retire. Please recognize that when you retire, it doesn't necessarily mean you have to file for Social Security or your pension, or that you have to take out or cash out your 401k all at once. You know that. Tax loss harvesting is where you sell investments at a loss on purpose to offset gains that you've already realized. So let me give you an example. Let's say you've got a $100,000 stock investment. You bought it years ago for $30,000 and you decide to sell it all today. Well, you would realize a $70,000 taxable gain from the sale of that investment in the year. And to offset that gain, you have another position that's down $40,000 from when you bought it. So if you sell that position that's down $40,000, you can use that to offset the gain of $70,000, and now you're left with just a $30,000 taxable gain, as opposed to you being on the hook for gain and tax liability on the 70 grand. Now, when you sell that investment, you can buy something similar, but it can't be substantially similar. Otherwise, you'll trigger the wash sale. The wash sale rule is essentially the way the IRS makes sure that you're not playing games with your investments. You're not just selling it on purpose to realize a paper loss without there being a material change or something of substance in your investment strategy. So let me give you an example. You could, if you wanted, own Home Depot stock. And let's say Home Depot stock in this example is down. In fact, it's down 40,000. You could sell that Home Depot stock and buy Lowe's. That's a substantially different company than Home Depot, but you and I understand they're both in the same business of home improvement. Now, from an investment perspective, Home Depot played a specific role in your investment, and it's likely Lowe's can fill its shoes pretty well. That will allow you to harvest that loss and use that loss to offset the gain in your portfolio. And most people don't take advantage of this throughout their lives when they're saving, and especially when they are living on that income in retirement. See, most people, when they retire, they don't have a strong investment strategy or a distribution strategy, which is probably just as important in terms of them deciding where to take money from to live on in retirement. And if all you do is take money a little bit from the bank, a little bit from a brokerage, an IRA, or Roth, the 401k, you're not as tax efficient. In fact, you're leaving quite a bit on the table in most cases. For most people, when they retire, the first place we go to is cash outside of qualified retirement accounts, like money that you would have in a brokerage account or CD or money market, for example. When you sell investments that aren't CDs or money markets, you typically have capital gains if they've done well for you over time and you've seen some growth. Tax loss harvesting, not only during the saving, but also during the distribution phase, can help you reduce taxes and keep more of your hard-earned money. The second common mistake, and this is probably even more common, is that people don't do tax gain harvesting. This is where you sell particular investments at a gain, even though you don't need the cash. You buy that same investment right back if it makes sense for your continued investment strategy. And that allows you to step up your basis. Let me give you an example. This year, the United States tax law allows for a couple who's married filing jointly to recognize roughly $95,000 of long-term capital gain without being subject to any federal income tax. Now, the way that it works is we look at your regular ordinary income, and let's say in this example, you have $50,000 of taxable Social Security income, and that's the only income you have right now in retirement. In this example, a couple who's married filing jointly could recognize $45,000 of long-term capital gains and pay 0% tax on those gains. Had they done nothing, they would be leaving money on the table. They wouldn't have filled up appropriately that very rare 0% long-term capital gains tax bracket. And that would be wise and unfoolish, because down the road, if they have other sources of income, maybe the pension's turned on for them, or they're taking money out of a 401k, maybe even an inherited IRA from mom and dad. Well, now they have a lot more income, and they may not be in an advantageous situation if the day comes that they need to sell that stock, because now they'll pay tax on that sale of the stock. Because after the 0% bracket, we have 15%, and after 15, it goes to 20% as the tax rate. So harvesting positions, or in other words, selling an investment, recognizing the gain, buying it right back, allows you to step up your basis, and in many situations can help you stay in the 0% tax bracket. And the same thing could be said for 15% as well, although it's probably not as common to do it at that level of income. Be aware that the same rules that apply to tax loss harvesting, particularly the wash sale rule, does not apply when you recognize a gain. In fact, the IRS is stoked for you to sell investment at a gain because it has the potential, at least, to be considered a source of tax revenue for them. Right? They're not going to stop you from recognizing gains that potentially could generate income for them, but they might have a hard time with you generating losses, at least paper losses. So those don't apply. You can sell the investment and buy it right back. And you don't have that 30-day before and after window that applies with the wash sale rule. Let me just speak on that for a moment. So back to tax loss harvesting, you cannot buy a substantially similar investment within 30 days before the day you transact or 30 days after the day you transact. Otherwise, that loss is washed and it stays in a bucket off to the side. You can kind of think of it, and you don't get to realize that loss until you actually satisfy the requirements and those rules. It's a big piece of the puzzle and something you want to be aware of. Again, both of these strategies apply within brokerage accounts, not inside of IRAs, 401ks, or other qualified retirement accounts. A word of caution: when doing tax gain harvesting, there may be alternative impacts to your overall financial plan. For example, if you're on Medicare, or maybe you're on an Obamacare plan, you shopped for health insurance with the Affordable Care Act through your state's marketplace, it could potentially cause you to pay more in monthly premiums for that health insurance coverage because now we've increased your income. And although we've kept you in the 0% federal tax rate, it could have alternative impacts in terms of the subsidy that you're getting through Obamacare or other healthcare related concerns that you may have. There's a few other ones that might apply, but just recognize this is part of financial planning, right? When we do financial planning, we are looking at your situation, your goals, where you're at today, and making sure that any tax strategies, investment strategies, or cash flow strategies that we use make sense for you. And just because somebody saved a lot in taxes or invested in this particular investment and was successful doesn't necessarily mean it's the right move for you. The third discussion point is distributions in retirement. See, most people don't recognize that when you reach a certain age in retirement, which this year is the age of 73, so if you turn 73 this year, you now have required minimum distributions. This is where the government starts to force you to take money out of your pre-tax retirement accounts so they can tax it and generate income on it. Remember, the money that you put away was never taxed going in. Or if your employer put it in as a matching contribution, you never paid taxes on it then either. But now the IRS wants to get a slice of the action. They want to get their money, and they may force you to take money out. It's important that you plan for required minimum distributions because for many retirees, we see a spike in income in the years following their birthday of 73. And you don't want to be left holding a big fat tax bag of you know what if you can plan ahead of time and think about what's coming down the road in your future. This may mean you do more distributions from your 401k or IRA earlier on, or a Roth conversion. At least a Roth conversion strategy maybe over a number of years to help reduce and mitigate that tax liability. Because remember, Roth retirement accounts do not have required minimum distributions like their pre-tax counterparts do. And if you've got a bunch of money sitting in retirement accounts that has not yet been taxed, like traditional 401ks, IRAs, maybe you work for the government, you have a TSP or 403B plan, this is a potential source of income for the IRS, which means it's a tax liability for you. And by doing a little bit of planning ahead of time, it can help put you in a stronger position to take advantage of retirement planning opportunities when they come. My name is Rizik. I'm a financial advisor. I'm a CPA and certified financial planner. If you enjoyed this, you're going to love my new book, Finance on the Fly: Simple Strategies to Build Lasting Wealth. You'll find it an insightful tool and resource that uses simple, plain English to describe what otherwise might be complicated topics. Tax, investing, retirement, they don't have to be confusing or difficult to understand. And by taking some key steps today, you can put yourself in a stronger financial position long term.